All right, everybody, welcome back. So in this video, we're going to talk about how to approach trading in the futures when you really just don't know what you want to do. You have to have a place to start. Everything comes down to money management. It always comes down to money management. So if you don't have a place to start, I'll show you what I did, and you can try to use that for some structure on something that you could do. So I already had experience trading, been trading options, stock, just not much in day trades. The thing about trading price, it doesn't matter what time frame you're on. If your trade strategy works based on price action, then that price action can be found anywhere. So I already was coming into this with an idea of what kind of trades I wanted. I just didn't know about the stops, for an example. So I went over to paper and I started trading my strategies live market in paper, just getting in at where I thought it was appropriate, as my strategy said it was the place to get in, like a 5-minute breakout with a Busby, or a 15-minute failed flag with a Busby, bouncing off of yesterday's high and going short. Whatever my playbook said, I would take the trade as defined in the playbook. And I didn't use a stop because it was paper and I wanted to see if the trade would unfold, what kind of risks I would be dealing with and what kind of price action I would be dealing with. Now, a lot of things have to come into play. The kind of day that we're having, is it really violent? Are the candle sizes very big? But I needed a starting place. What kind of stop did I want to use? Well, I didn't know. But what I did know is how much I was willing to risk. Now, I know me, I did not want to risk more than $150. Now, we're not talking points and ticks and getting confusing. We're talking just straight up cash. How much money am I willing to risk in one particular trade at any one time? $150. Knowing that number gave me a lot. If I'm trading the ES, each point is $50. I could use 3 contracts and use, a 1-point stop, for an example. If I'm trading the MES, then I know that I could trade multiple contracts and have a very wide stop. Just because I'm willing to risk 150 doesn't mean I wanted to lose 150 per trade. Stops are not my way of figuring out that I'm wrong. Price is going to tell me I'm wrong, and I'm going to look to get out when it's telling me, hey, this is wrong. You went long, you should have went short. But I was willing to risk up to $150 per trade. Now, you can approach that number. If you don't have a number, you can approach it from a lot of directions. Institutions and a lot of trading firms say that you should not risk more than 2% of your entire account. So that's a good place to start. If you have nothing else, think about that. Right now, if you've got $100,000 account, no, you should not be risking 2% of that. Right? Like, don't just rubber stamp it and say, well, that's what they say, so I'm going to go in and risk 2%. Heck no. But if you have nothing at all to think about for a number, maybe that could be your guideline. I would never go higher than that number, but you could certainly go a lot lower. Find a number that suits you. Right? Nobody says you have to put that much at risk at any one time. But you would now have a cement number that you could never risk more than that. You're not allowed to risk more than that max risk value. So for me, I now knew that I would never risk more than $150 per trade. However, I put that together using 1 contract and a really wide stop, maybe using 2 or 3 contracts and a much smaller stop. I could put it together any way I wanted as long as I never risked more than $150 per trade. The next thing I needed to decide is, what will my risk to reward be? What is my strategic risk to reward? Now, the industry standard suggests that we should at least aim for a 1 to 2. At least, right? I looked at my personal trade results and I noticed that I was doing much, much better than a 1 to 2. But I continue even now every day to make that number bigger. So right now, my strategy says I need a 1 to 5. My personal goals are that I need a 1 to 11 because I'm getting already more than a 1 to 5 at this point. If you don't have a risk to reward number, start with a 1 to 2. That's a real good goalpost. And if you're already exceeding 1 to 2, great. Aim higher. But you should at least be aiming for that in every single thing that you do. A 1 to 2 means we are risking 1 to make 2. Now we're talking ticks, points, dollars, whatever, however you want to do it, in whatever context you want to do it. Are you risking 2 points? You want to make 4. Are you risking $20? You want to make 40, right? So that is your starting place. No trade you take should ever lose more than $150. And every trade that you take should have the potential to make twice your stop. That's a 2 to 1, twice your stop. So just having this in place, I could go and I could paper trade. And I know nobody wants to paper trade because it just seems like it's fake, it's not real, it's just crap. But there's a lot that we can learn in paper. Are we using a stop that's too tight? If we're constantly getting wicked out of trades or stopped out after we get in, and it never has a chance to prove us right, it stops us out and runs away, stops us out and runs away. Our stop is too tight. We can't use that stop. Something's wrong. Trading on paper would tell us something's wrong, so we wouldn't go live and lose money from getting stopped out all the time. It would inform us, hey, that's not going to work. Okay. There's a lot of things we can learn from paper. So go to paper with an idea of what your max risk should be. Make that your stop just to start out. And if you find that you're not coming anywhere close to that max loss value, that's awesome. Then make your stop smaller, because your stop does not have to be your max risk. I don't risk 150 per trade. I just know that I'm not allowed to risk more than 150 per trade, no matter what. I can certainly use less. Take pictures of every single trade you take. The pictures are there for us to go back and review. Why did the trade lose? Did you get stopped out? Why? What time of day was it? A 2-point stop in the NASDAQ works just fine at lunchtime in the Globex, but a 2-point stop at 9:35 in the morning, I'm going to get stopped out constantly. So I would either need to use a bigger stop if I'm going to trade at 9:35 in the morning, or I would need to quit trading 9:35 in the morning, because there is not enough room in that violent market for us to trade without getting stopped out. So taking pictures of every trade helps us go back and ask, what are you doing wrong? Why are you losing all the time? And it could be something as simple as trading in the wrong time of day. It turns out that there is dyslexia when it comes to reading price action. You could be doing everything exactly the way you're supposed to, but backwards. I didn't know that that was a thing. I learned about it as I coach people. I had someone that was dealing with that situation. And when I finally started to see some of his pictures, we found it. It was a great aha moment, right? So if you're not taking pictures and then sharing your pictures, we don't know what to fix. We don't know what is wrong. So take pictures. Don't be embarrassed if the trade loses. Losses are inevitable. Everybody loses. They're not a reflection of your skill. They're not a reflection of your intelligence. Just because you lose, that doesn't make you stupid. It doesn't make you slow. It doesn't mean you suck. It has no reflection whatsoever ever on your skill set or your mentality or your intelligence. Take pictures, learn how to go in and review that trade. And you learn that by sharing pictures. So come and share the picture, put it in the Discord so we can review it. Take a picture of your trade and let's go back and look what is right, what is wrong, what can we do better next time? Why did this trade win? Why did it lose? Was there even enough room in that trade for you to get your 2-to-1, right? And that helps us decide, should you have even taken the trade? What you will find when it comes to money management is when you get it dialed in, it keeps you out of the market. It says, hey, you can't get in here. There's not enough room. And it lets you know that a trade just is inappropriate, right? And that's a great leg up for people who don't quite trust their own ability to read the market. If there's not enough room for you to get in, you just can't get in. So take pictures. Money management is the number one thing above everything else. So once you've decided what your strategy is going to use, and then you come in and you paper trade live, then at the end of the day, at the end of the week, at the end of the month, you want to go in and you want to calculate what is your historic risk to reward. The first one is your strategic risk to reward. What are you trying to accomplish? And then the other one is, what did you actually accomplish? You may have been aiming for a 1-to-2, but you could have actually been getting a 1-to-3 or a 1-to-4 or 1-to-5. On average, what are you hitting? To get these values, I wrote a blog post. It's on the OEC coaching website under money management, and it explains how to calculate the SRR and the HRR so that you can go in and calculate those values. We need those. Okay. So how I approached it, I traded on paper, and I didn't just trade random price like, well, that looks like a good place to get in. I'm going to go long here. I'm going to go short here. I traded very specific trades from my own playbook. Now in the playbook, there are a lot of trades, right? They kind of add up after a while. There are some common ones that we've all talked about before. Things like trading the gap close, trading an open range breakout or an initial balance breakout. All of these trades have very specific plays in the playbook. They're not arbitrary at all. When I take a trade that matches one of these criteria, then I specifically say I traded a gap close. Did it win? Did it lose? What did I get right? Was there any warning? Is there any way that I could have avoided losing here? What can I do next time? Or did I trade, a failed flag? Was there any warning that the trade was going to turn out like it did? there are ways that we can get better when we recognize the trades that we're taking. Remember, we're trading a behavior in the market. Once we recognize what that behavior is, we then have to go in and determine, well, how am I going to trade this particular behavior? Right? Like we've noticed that the market sets a 5-minute open range. That's a behavior that the market does. Once it has set that 5-minute open range and then later on breaks out of that range, we can trade that. So we take a behavior that we've recognized and we build a trade strategy around it. How do I want to trade when price leaves that 5-minute range? Do I get in as soon as it breaks out? Do I wait for a Busby? When the Busby is coming in, do I put an order on the dome? Or do I wait for price to come down to that level and turn around? How do I want to do it? There is no wrong way there. Aggressive traders are going to get in earlier. More non-aggressive traders are going to wait for a confirmation or a turn. Each side has consequences and each side has benefits, right? Getting in early means you're going to get more of the move, but you're going to lose more often. Waiting for it to confirm means you're going to miss more of the move, but you're going to lose less often. It doesn't mean you won't lose at all. Both sides are going to lose, but you will lose less often. Everything has consequences. It's not about which one is right or which one is wrong. It's not about, well, how would I do it? Mine change constantly. How I get in is dependent upon what I'm seeing in the market that day. And it depends on how the market approaches a level that I'm looking to get into. Did it approach that level very quickly in one big candle? Did it ease its way into that position, into that spot with a lot of smaller candles, like a slow grind? There is no right or wrong way to get in on an open range breakout. It's which way suits you. Trade it different ways. See which one you like better. It still needs to match your risk to reward. So in your journal, keep track. Are you specifically trading one of the plays that you have? And if you don't have any, then that's something else we have to focus on. How do you want to trade an open range or a gap close or a half-day wedge breakout? Keep in mind, a lot of these don't show up on a day-to-day basis. You may not see some of these for weeks at a time. Well, that can't be the only thing we're going to trade if we don't see them week after week after week. We can't just sit at the computer every day hoping that we're going to see a double bottom or a failed flag. We want to have these when these things come along, but we also want to have something else that we can trade. The something else becomes range and trend. And I'm moving those two because there is range days and trend days, but there is also just straight range and trend. We can find trend anywhere. On any time frame, we can find a trend. And on any time frame, we can find a range. So these are very specific trades. And then outside of that, there are also just price. It would be good if your playbook had both of those. But even when we're just dealing with price, price has a repeating behavior. It'll give us micro ranges like a shadow candle. And those micro ranges not only do they give us shadow candles, they give us very close, very near term support and resistance levels. They become minor pivots. So we want to use those to our advantage, right? And when we do this, we just trade the time frame that we're looking at. Micro ranges or micro time frames can be stepping into a 5-minute chart rather than, being on the higher time frames like the 15s and the 30. But it could also mean stepping down to something like a 2-minute chart. When we're trading a micro range, we're literally just looking left at the most immediate pivot minor and taking a trade based on it. And that's how the bulk of my trading gets done in the Globex, because we don't get failed flags and we don't even have initial balance in there, right? We don't, 9 times out of 10, most of these things aren't in the Globex. We have to just trade the most immediate price available. And that's one of the reasons that my Globex targets are so small, just trying to get my 10 points. If I can get more than that, great, but I'm not going to aim to get more than that. So approach it from this point of view. Set your max risk, whatever that number happens to be. That will tell you how many contracts and what a stop level should be, because you will never want to exceed that max risk per trade. And then pick your SNR levels. What is your risk to reward strategy? If you don't have one, aim for a 1 to 2. Prove that you can do that. If you can prove that and you're doing better than that, then we'll make it higher. Then go in and trade, and just trade what you know. If you don't know any of these, then we now know the next thing you've got to work on, right? But I've got videos on open range breakouts and double bottoms, and I've got videos on these trend days and how we want to develop the entry for these. If those don't get it, we will just go in and manually do it. But I've got videos on these. Trade those. These don't come around every day, so you may find it hard to go in and paper trade this on a day-to-day basis, but there's always the micro ranges, a 5-minute range, a 15-minute range, or a 30. Trade these for a month, and at the end of it, look at your trade history. The whole time, take pictures. Take pictures, share the pictures, annotate on them. What was your risk to reward? What was your aim? Why did you think you can get to that level? What happened? Did it win? Did it lose? And at the end of that month, we will have a lot of numbers at that point. We will know what your average winning trade looks like. We will know what your average losing trade looks like, right? We'll know what time frame you're trading in, and if your stop is appropriate. You will learn if your stop is too tight, because you're going to be getting kicked out all the time if it's too tight. You'll know if your stop is too big, because you will be constantly not getting hit in that stop, and you'll have a chance to really recognize, like, wow, price didn't even come close to my stop every day this week. Wow, that means your stop is really big. You could probably tighten that up a lot. So we will know a lot more about your position and what you're doing and what you need to work on after we have some real results. And then we can start looking at what your actual real history is, and we can go from there. So from this, my personal goal was a 5 to 1. I wanted to risk 1 to make 5. In the Globex, on the NASDAQ, I had a 10-point target because I had a 2-point stop. That was my 2 to 1 or 1 to 5 risk to reward ratio right there. If you don't have a stop value and are thinking, I don't know what to use, try using mine. If you try to use a 2-point stop in the Globex for a month, and you find that you're constantly getting stopped out, we will know either that you're using a stop that's too tight, or that you're trading in a time frame that is too violent. Maybe you're in Globex, but you're trading right at the open of the dollar or right at the open of the Asian session. We'll know a lot more about what you're trying to do. Just because I use a 2-point stop doesn't mean that you can, but it would be a good place to start. Also, keep in mind, if you notice that the trade is losing, get out. Don't let it hit your stop. Stops are not there as a definitive statement that says, yep, you were wrong. Stops are there to help you not lose worse, right? Help you not take a bigger loss than you wanted to take. But if you can get less loss, do that. Now, my intraday NASDAQ is risking 5 points. And that's because for the last year, it's been very violent. It has calmed down significantly, but it's still pretty rough out there. And there are days where I need that 5 point. When I can use less, I do. But I'm not allowed to use more than a 5-point stop. And of course, that gives me a 25-point target. Those are my values. It doesn't mean that that's what you should be getting. If you're risking 1 to make 2, then you're always going to want to multiply your stop times 2. I multiply my stop times 5. If I risk 5, I need 25. If I risk 2, I need 10. If we risk 1 to make 2, and I'm risking 2 points, then I have a 5-point target. In the intraday, if I'm risking 5, then I need a 10-point target. Okay, but I set mine to a risk 1 to make 5. And that gives me a 5-to-1 risk to reward ratio where I always just multiply my stop times 5. So if these are my values that I do, what would that look like in the charts? So we come in today and we look at the NASDAQ. If I wanted to try to go long off of these lows, and that's a great pivot point that we can all trade, right? That's the institutional pivot point. We can always trade those. If I'm looking to go long off of these lows, what kind of expectation for profit could I have? How far is price expected to go? Well, it only owes me back to the top of the range. So we're looking at 34 to 84, right? Just for easy numbers. It's a 50-point range. I can have a reasonable expectation of getting 25 of those 50 points. So my 5-point stop is not out of line. If I was looking to go short off of these highs, what would it owe me? The same thing. But each side has an added area of risk. This midpoint is an area of risk. So price owes us from one side to the next, but we have to be concerned about the middle because we could stall there and reflect back up again. So if I go short off the highs, I'm going to want to focus on that middle value, and I'd want to have a target of this lower value. If it comes down and it gets hung up there and it's not making its way through, I'm going to try to take most of the trade off. Maybe I have 3 contracts on, I'm going to take 2 off and just leave a runner. And I'm going to see if we can get through that level and close the trade down at these lows. And that way, if we do reject and we start coming back up, it can stop me out. I got stopped out with profit. Maybe not the profit that I was aiming for, but I didn't lose in my trade. We want to be able to adapt and react to the market that we have. This is the range. And if we were to go short off the highs, the expectation is that we could make it back to the bottom of this range. But we do have to be mindful of this here. And it matters because we've been in this move to the downside. Well, we don't know yet if this is a pullback before it goes lower, or if it's a change in market sentiment, because this could continue that move to the downside, right? We don't know. But what if this is now the low and we're building a base, and now we're looking at it from an entirely different point of view? We're no longer thinking that this is just a pullback before we go lower. Instead, we're looking at a market that is moving this way. And it's only a pullback before moving higher. See how the entire situation is now different. Now, why do we have an expectation that this could happen rather than the other one? Well, look at how much time it spent going sideways here. Earlier, it spent much less time before it resolved that and went down. So we just don't know. We would be prepared to kill the trade here in the middle if we had to. We would even be prepared to take half the trade off or more than half right there if it got hung up like it did right now. It's not easily moving through that level. We don't want to kill the whole trade because we did put risk on. We want to hit our appropriate risk to reward levels. But we can recognize the situation, get most of the risk out, keep the trade on, and see if it can get down here. If it can't, it'll stop us out with some form of profit. I'm going to go to the ES, not because I want to talk about the ES, but because it's a different chart. So what could we trade here? Well, nothing at the moment, right? We're not at the low. We're not at the high. There is no opportunity yet. If we had got here before it turned, we could have tried to trade the low, right? Getting in at the high and going lower. We can also be prepared. We can look for an opportunity to trade this. Where would we want to get in? We would want to get in at the low. So we can set an alert and wait for price to get down there and go do something else, right? We don't have to sit here and watch it. When it gets down there and it triggers our alert, we can come in, evaluate the situation, and look for a trade to the upside. What's our expectation of profit? Well, from 93 to 03 is 10 points. This is like a 13-point move. Our stop would be different from the NASDAQ to the ES. If you're going to trade in the ES, you're going to need an entirely different stop value. How much would you be willing to make? Well, remember, we know what our max value is, our max risk. If I'm willing to risk 150, then my stop can be less than that 150. Anything at all, as long as it's 150 or less. So I could use one contract and a 2-point stop. Then I'm only risking $100. It's less than the total value. Would a 2-point stop work in here? Sure, I think so. It doesn't seem to be moving too violently at the moment. So we would look for price to get down into this area, and we would want to get a trade. If I'm using a 2-point stop and I want my stop underneath this lowest wick value as much as possible, then I'm going to try to get in as close as I can to this lowest point. But how do we know price is actually going to make it all the way to that lowest point? Well, we don't. So maybe I get in with multiple contracts, right? And I use a different stop so that I can use multiple contracts. Maybe I'm going to trade 2 contracts and a 3-tick stop, right? Then I'm still risking 150 points. I'm risking less than that, actually. So however way we want to do it, right? We can get in early. We can set alerts and wait for price to come down here. I like to wait. I like to let price come down here because a double bottom is supposed to go lower. So when we have price and it hits the bottom, and, and then it comes up and it's kind of doing this and it comes back down, it's supposed to go lower. A lot of technical books talk about that. Double bottoms are not supposed to be equal. Well, this would be a double bottom. If it's literally supposed to go lower, I don't want to put my order in on that spot. I want to wait for price to resolve this and begin moving its way back up. And if I'm going to risk 1 point, then I need to know that I can make that kind of profit. If I'm risking 1, I need to make 2. If I'm risking 2, I need to make 4. There is enough room to make that. I could take the trade. All I got to do is let price come down into this area, prove to me that it's going to hold here, and look for an entry. Look how it came up into this area, and then it lingered there, really struggling to go higher. This is a topping pattern, giving a lot of indications that it wasn't going to go higher. Somewhere along in that would be your opportunity to go short. Well, we would be looking for the same thing down here, some kind of bottoming pattern. It's really hard to trade these V-shaped moves because it never really gave a pattern down there. But when it gives a topping pattern or a bottoming pattern, that would be our opportunity to get in. So we can always find a trade on any time frame. We can always find a range. We can set our alerts for that range and trade that. Now we're on a 2-minute. Well, we could just as easily go to a 5-minute. There's our same double bottom. When price comes back down to this low, we're going to be looking to trade that. How we attempt to do that trade is based on our own aggression level. It's also based on how the market approaches that level, in really big candles really fast or slow grinds working its way down there. If it resolves this low, what does it owe us? Back up to these highs. Where's our warning? Where's our area of concern? That blue line running clear across the screen. So from this low, as we begin to move up, I want to be concerned about that area. I can take some of the profit off there. At the end of the trade and at the end of the day, I want to see that I'm making twice as much as I'm risking. That's my 2-to-1 value of importance. Every single trade, every single time won't match that level. Our aggregate values, our averages should reach that 2-to-1, 3-to-1, 5-to-1, whatever your risk to reward is. This is a really great place to start. I look for some feedback from you guys. Start putting in those pictures, start submitting them, share what you're working on so that I can help you work on it.